Hello, everybody. I am very shortly going to be joined by my distinguished panelists, Denise Le Gal, who is the chair of the Brunel Pension Partnership, Melanie Cusack, who is the client director at PTL that offers independent trustee and governance services, and Mark Walker, who is the CIO at Coal Pension Trustees. So it's a very, very warm welcome to you all. Thank you for joining us this afternoon on an interesting and very relevant topic in this week when we've had so much news flow. I just want to take a moment to pause and say, I bet we're all feeling remarkably and possibly stupidly optimistic because of the news of the Pfizer vaccine, but I think it changes the nature of our thinking to think through the COVID crisis and through to the other side. But also we've had other amazing positive news this week, as well as challenging news. And there's never been a better opportunity to gather the experts that we have on this panel to think about a very, very important topic for many of us, which is fiduciary duty. Is it a fiduciary to care or a fiduciary duty of care? And that's what we're going to be discussing, not in a theoretical way, although we have got some very, very good work done by lawyers on the principles around this, but in a very practical way. Why the Impact Investing Institute thought it was a good time to do it is because there is so much expectation on pension funds, other asset owners and investment managers that there is a duty to care, whether it's on climate change, in response to the coronavirus, or social justice. There is an increasing amount of noise around what our responsibilities are. And we thought it was timely to bring people together who really do have insights into what it works like in practice. Only this week, we had an announcement from the British government regarding mandatory reporting on TCFD by 2025, with steps in between to 2023. We had the governor of the Federal Reserve Bank coming out with their financial stability assessment this week, warning of pricing irregularities and vulnerabilities because of climate change. And we had previous Governor Mark Carney talking about opportunities of a lifetime associated with those companies who are getting it right and working towards a transition to a net zero economy. So whether it's a duty to think about risks or opportunities, or just to think, we thought it would be a very good chance to have that discussion. We're going to do it in several parts. First, our panelists are going to make some opening remarks. They'll say a little bit about themselves and what they think about the topic. Then we'll have a panel discussion, but we warmly invite you to submit questions and answers. Using the normal functions that we're all too familiar with now in our second or third or fourth period of lockdown, depending on where you are in the world. So please do submit questions because we will be very, very interested in making this interactive. Hopefully there'll be about 15 to 20 minutes at the end for that. But I'm delighted now to turn over to Denise to kick off the thinking for us. Denise, over to you.
Thank you very much, Elizabeth, and good afternoon, everyone. My name is Denise Le Gal, and I chair the Brunel Pension Partnership. Brunel is part of the local government pension scheme and is a pool of some 30 billion worth of assets of 9 county funds, mainly in the Southwest, and the funds of the Environment Agency Pension Fund. Why I said yes to this panel is because, quite simply, fiduciary duty is a topic we discuss frequently at the board of Brunel, and I liked the way the question was framed, a duty of care or a duty to care. Stepping back, everything we invest in has impact. The question is it good impact? Is it bad impact? Is it sustainable? Is it resilient? Expectations around fiduciary duty are different in different places. There is an element of horses for courses to it. But one common element that we do see is that it is no longer just about hardcore financial returns. It's increasingly more nuanced around impact and outcomes that are both sustainable and resilient. We believe that impact will only become more and more relevant in the years to come. So that requires that pension funds like ours go along the road that the leaders are setting and going one step further to help influence and shape the policies as they are set by governments and regulators. So individually, as citizens of the world, this is the lens I like to look at it through, is that we have a duty to care. Our duty to care is shaped by how we view the world. So post-COVID-19, for example, we sense a heightened consciousness around climate change and human capital, to name a few. and we want to do something about that. The duty of care can be viewed as the sum of the views of those individuals' views collectively. In other words, the duty of care as the collective duty to care. But we have to be careful of the collective momentum, that it doesn't go too far. If you go too fast, for example, by excluding so much that you lose any meaningful engagement, one might risk being in breach of the trustee's duty to care. Trustees are not NGOs. It's really about being balanced in terms of risk and reward assessment. So for us, fiduciary duty is all about managing fiduciary risk. If you focus on risk rather than financially return in a balanced way, you should get it right. Both are important. So it's that balance that is right in terms of getting it right between risk and return. But looking ahead, our underlying funds are shifting their focus from traditional asset classes to impact and outcomes. They now want us to make all of our portfolios sustainable and responsible. This is a big challenge and not as easy a task as it may seem, as it looks very different for different asset classes. And the impact will be different for each of these. But the point remains, to maximize impact, our clients and Brunel want to exercise our duty of care and our duty to care through the prudential stewardship of our beneficiaries' assets. And in doing so, we hope to forge better futures by investing for a world worth living in. I think I'll stop there, Elizabeth.
Thank you, Denise. Now, I was jotting down some of the key points. I know we've got so many questions arising, even from your opening remarks, but I'd like to move on through the other panelists first. Melanie, why don't you talk to us about what it's like as a trustee and advising trustees, and particularly you pick up the governance aspects as well as the investment aspects. So over to you.
I'll do my best, Elizabeth. Thank you. Good afternoon, everyone. So Melanie Cusack, I'm an independent trustee, professional trustee, have been so for about 11 years. I've got about 17 schemes I sit on the boards of, and they range in sizes from little ditty ones to quite significant ones, mainly DB, the defined benefits, but some in the defined contribution world. And I'll come to your point, Elizabeth, but I think one of the reasons I wanted to be on this panel was as a professional trustee, I have a voice. You know, I believe we're already expected to focus on things like good governance and ensuring good member outcomes. But I feel this voice should be used as well to be expected to look at social responsible investing, better yet, to make an impact, echoing a lot of the things Denise just said. Not least, though, because there's already been rumblings in the UK that suggest it's only a matter of time before members demand it of us. So we can sit here and talk about what we want to do with our money, but I think there's an expectation that is rumbling below the surface and has been echoed in other countries. I mean, there was a case in Australia just announced a couple of days ago. So I feel it's our fiduciary duty to actually consider the members' expectations, not necessarily the engagement. I'm sure there'll be a topic we talk about later on today, but there is a duty to think about what they do expect us to do as custodians of their pension benefits. I think the timing for all this conversation is absolutely perfect right now. Trustees in the last few months have had to actually sit back and examine their beliefs. What are they doing in this area? They've had to state it in an online forum, stating their investment principles. And we need to keep that momentum going. Now's the time while it's still fresh. There's so many things on the trustees' agenda. Any trustees on the call will be going, oh, I know I should be doing such and such today. But we just need to keep that focus, that priority going right now. The other question I have is, why not? We hear a lot of people say we can't do this, we don't have this available, and our investment consultants aren't helping us. And my question is, well, that there are reasons why. You're answering the question, why do it? I'm saying, why not? Now's the time. We're always looking at our investments and being told, oh, there's a risk return trade-off, as Denise pointed out, and you know, you can invest in equities and get this expected return, but there is a potential downside. Well, isn't that one of the reasons why people say don't do this? There might be a slightly lower return. We can invest in equities quite happily, knowing that downside. Why not even just consider this? Take that risk and change your mindset, because also these expectations are based on a set of assumptions that don't really even take this sort of impact into account. It talks about other factors. So I think there needs to be a change there. And one thing I just have to throw in, one of the reasons I have to do this, I feel duty bound to do this, is I have 3 young adult daughters who challenge me on pretty much everything I do, every global issue. We recycle, we compost. I have a bamboo toothbrush. However, this is an area in my professional life that I feel I actually have a duty to do something to make my daughters proud. I think that's enough for me at the moment. Thanks, Elizabeth.
That's fantastic, and it's already prompted some questions which I'm going to come back to because they're brilliant. But I'm going to ask Mark. So look, Mark, everybody's expecting you as the Chief Investment Officer of some large and complex pension funds with multiple stakeholders, which is one of the points that's come in as a question, which is a great point. It's straightforward, isn't it, as a Chief Investment Officer, just to do this? Give us your perspective.
Oh, of course it is, and it's even more straightforward when some of your trustees are ex-miners and from the fossil fuel industry. Just on that point, so I thank you for the introduction. I'm Mark Walker, the Chief Investment Officer of Coal Pension Trustees. The clue's in the label. We've had no active members for the last 25 years since the industry was privatised in the UK. So we're a pretty mature set of pension schemes, but we've still got over 20 billion of assets, and unusually perhaps for that level of maturity, we've got extremely high return targets supported by a government guarantee. So an unusual set of circumstances, and I was keen to be on this panel when asked, not least because I have some reasonably strong views about the subject matter, the industry itself, and of course in my case as a CIO, the practical application and ways of perhaps delivering some of the more objective-based and outcome-based objectives that we see in this area. And just a few reflections on the subject. And firstly, to build on what Melanie said around mindset and fiduciary duty. I'm no lawyer, and apologies to any lawyers who are on the call, but I do think we really get mixed up sometimes from a fiduciary duty perspective, that we have to separate things into financial and non-financial. Maybe if we adopt this as the Impact Investing Institute's principles that I'm sure you've all read came out recently, the first principle about mindset, adopt a transitional mindset. If the world is changing, capital flows are changing, and we may have to make money or manage risks in a different way in the future, are these financial and non-financial issues really so unconnected? Perhaps they're actually the same thing, and the non-financial issues end up being financial in the future. So I do think this mindset, the mindset that people adopt about investing and their objectives and making money is really important and quite relevant for how we think about fiduciary duty. Alongside that, and here's the investment elements, how do we measure success? What's risk in the industry? We've got an industry that's very transactional, very product driven, very distribution driven, very consultant driven in some areas, or it certainly can be. And perhaps when I think about my objectives, I have to deliver a real return, and risk is not volatility of a funding level. Risk is a permanent loss of capital. Well, if I've got some stranded assets in my portfolio because of environmental, social, changing consumer preferences or behaviours, then that's a risk to returns. Those are financial. And then the final point I just to make is on process, which is connected to the industry issues. How do we get things into the portfolio as investors, as asset owners, or quite frankly, as fund managers? What's the decision-making structure? An ex-colleague of mine who works at a fund manager told me that when a fund manager had decided to buy a stock in the portfolio, he then came up and asked, could you just complete the ESG schedule for it? That's not integration of thought or future direction and so on. How do we establish asset allocations? We think about asset liability modeling. We think about risk returns and correlations, which are largely based on what happened in the last period of time and perhaps not what might happen differently in the future. So I think there's quite a large number of barriers we've got to whether we have a duty of care, a duty to care, or indeed both, because those two things are the same. But how do we practically make a difference in the investment portfolios we have to oversee?
That's brilliant. Thanks, Mark. And I think we've got such a range there. I'm going to start with a question that's come in from one of the people participating, because it's actually a very fundamental one. Then I want to go into to build on some of the comments. And the question is, in UK law, do you think there's a barrier for thinking, basically as you're describing, to thinking about a duty to care? Is there a barrier in fiduciary law? Now, each of you in your own ways has implicitly said, no, there isn't. And by the way, the work we've had done by lawyers also suggests there isn't. But that's a really fundamental question. And I'm going to come to Melanie first. Why is it we still have a mindset that there is this conflict between to care and caring about the fiduciary duty as a pension trustee? Why does that conflict exist, do you think?
I think because trustees feel accountable. So I mean, in defined contribution schemes with default funds, there's a classic situation where the trustees are trying to make a decision about their members' money, recognizing that a lot of them won't even appreciate where they're invested or engage in the process until perhaps it's too late in the day when they could have taken some action. And I think there's that sort of trustees often tend to be a little bit more cautious than they would be in their own personal lives because it's other people's money, and so they tend to sit back and say, well, I don't want to risk being taken into account that I haven't been behaving within my fiduciary remit. But it's interesting how the word fiduciary sort of instills all these different things. We have fiduciary managers, we have a fiduciary duty. I'm not sure legally it's the word we should hang our hat on. I think actually our duty is to member outcomes. And so if you do that, and going back to Mark's point earlier about financial and non-financial impact or outcomes, I think everything at the end of the day is financial, and so you can extrapolate it and end up in the same place. It just depends how you describe the journey there. And I think this whole analysis of trustees having to sit there and actually question their beliefs to articulate them in a statement of investment principles has been really interesting. Having different, in my role, having lots of different advisors taking me on that journey with different boards of trustees and different backgrounds, it has been interesting how they've got comfortable with saying, actually, we're not necessarily going to categorize them because they all end up having a financial impact one way or the other. And how do we feel about that? So there's a little bit of hang up. I'm not a lawyer, though. I have to say I'm an actuary. But I feel there's a lot of hat hanging on that word fiduciary and the duty that possibly hasn't been stretched to the extent it should be.
I couldn't agree more. And that goes to Denise's point about mindset. Denise, you've got various different schemes, and obviously with coming from different heritages, different obligations. How have you addressed this as chair?
Well, from the outset, I think we have published the climate change policy earlier this year in January. And in that policy, we say that the financial system as we understand it today is not fit for purpose. And so as trustees, we tend to get stuck in these measurement systems that we've been using for so long and there are many myths that we need to bust, like that indices are safe. There's 2.97 million of them out there, 300,000 of them plus that are supposed to be ESG friendly or RI friendly. So you can create any answer that you want using any one of those indices. So are they safe? No, they can be very dangerous. And other myths like low tracking error is good. Is it? Why is that good? We will revert to the mean. We might not. The world is changing at a really rapid pace. GDP as a good measurement of productivity. No, it's not. It doesn't take into account so much of what is stimulating the markets today. So we have all sorts of things that are, if we hang on to them, we are almost invariably going to be in breach of our fiduciary duty because those things are no longer fit for the world in the way we live today. Now, in terms of our clients, they get this. And that's why I was saying in my opening bit that they're focusing on impact and outcomes. And they're not too hung up about the measurement of that because in some instances you don't have the data, but that doesn't mean that you don't do anything. So for example, in emerging markets, there's not much data, but there can be a huge amount of impact. So it's really about getting it mostly right rather than precisely wrong. And in the current system of measuring things, we are at real risk of getting things completely wrong in terms of exercising that fiduciary duty.
Thanks. And I guess, Mark, from what you were saying about the challenge of the information and the advice and this sort of very linear process that you have to deal with as a chief investment officer, how would you expand on what Denise and Melanie have said about how you give certainty and comfort about the likelihood of positive returns, but at the same time, knowing you're taking risks? Some of those might be based on historic, but some of them are unknown because they're future. How do you actually go about that? Take us through a little bit of the reality of your life and your team's life.
Well, okay, I could be here all day answering that question. How do people look at managers and products and so on? But I think that there's an element here that starts with how people get into the industry and the education that they have, and things like the CFA and all those sorts of things. There's the success measure points and incentives. If your incentives are to beat a benchmark, then you'll tend to behave to try and beat a benchmark. And if that benchmark is some sort of index, then I couldn't help smiling when Denise was talking there about all the indices and the risk in indices. They reflect something, but maybe they don't reflect the environment of the future. And everybody's seen the statistics about the biggest 10 stocks every 10 years and all those sorts of things. So we need to be focused on how, if our job is to make money, or maybe it's to manage a funding level or whatever, we need to be focused on how we're going to do that. And that's really hard because people like analysis and numbers and justification for everything that they want to do, and as do stakeholders. If you've got a group of trustees and you say, if I make this asset allocation or product decision, it changes my expected return from 2 to 2.5, that's okay then. It's gone up. So and then I think how people the top-down stuff is difficult. There's a lot of specialists, quite rightly, in this industry, a lot of really smart people, but it's sometimes hard. Change is sometimes hard, and taking into account more strategic factors, being in front of a crowd, all those sorts of things. Those things are sort of personal risk and career risk and all the things that come with it. So stepping out from a traditional way of doing things and thinking about how might I integrate the risks from climate or social disruption or the impact on jobs and so on from the energy transition, or those sorts of things. How do I get that into my portfolio? Do I go and find a product that delivers some aspect of that? That's how manager selection teams think. Do I change my asset allocation? Does that come out of the model that I'm using, the projections, the cash flows, etc.? And I think it's bringing all those things together. And I'm not sure I have a lot of good advice about the practical way of doing that, but I just go back to the points about mindset and an understanding that the world is changing quite rapidly, actually, and you could always say it's changing and it's a new normal and those sorts of things, but I think it is for any number of reasons right now, and we just need to be focused on how we're going to deliver in the future, not would have worked in the past.
And can I add, Elizabeth?
Yes,
sorry.
Please do come in. Yeah.
I think this is all leading to a conversation I've had with a few of my trustee boards as well, that you do all that modeling, as you said, Mark, and then we're measuring the performance against indices rather than actually what does success really look like to us as trustees, rather than to the manager we've appointed to deliver the investments that they've decided that they're going to manage against in some index, irrespective of whether that has any bearing on success for the trustees. And I think that there is a responsibility for the trustees to work with their investment consultants to actually work out what do we expect our money to be doing in terms of the managers we appoint. Because I've gone through manager appointment exercises where we ask them what their view on ESG is and what do they do, but then we don't really get any sort of concrete measurement of that, apart from perhaps a score from our investment consultant who's pulling together the performance monitoring. So I think there's a lot of room to develop that aspect as well. That's not a reason not to do it. It's just to help us gauge what success looks like. It still remains a bit challenging.
Can I
Yeah.
also comment on
Yes,
that?
please. Yeah, come in.
Because
Yeah.
Mark touched on the risks, and we do have a tendency to think we can mitigate everything away, and we do have in any investments we would have residual risks. And yes, we can use indices to paint whatever picture we may want, but at the end of the day, it's really net absolute returns after fees that count, and whether we're further ahead than where we were yesterday. It's really quite that simple. So when faced with the decision of where to invest, I think sometimes it's really important to think, well, of these decisions, they're difficult decisions in having to juggle all the various facets of it. Which one is the bravest one, and which one is going to deliver the outcome, the better outcome, not just for us, for our beneficiaries and for the world. And that's, I think we have to stick to that principle of mindset.
Yeah, although Denise, I do want to say it's not just about best absolute return. It's actually about delivering the members' benefits when they fall due.
Oh, of course, that goes without saying. Yes.
That's the unwritten
Trustee.
absolute. Yeah, no, absolutely agree.
Yeah.
There's a really rich set of questions coming in, and I want to bundle a couple together. And they're picking up on themes that each of you have mentioned. One is about how do you get that sort of forward-leaning mindset, more strategic mindset, balanced by career risk and moving away from benchmarks, tilting. How do you actually balance and make people braver and more courageous to do that when the downside can be very short term? So that's maybe a question first for Mark on the investment side. The second one is a really profound one, which is how do you balance the short term with the long term, and the periods over which we look at performance, the period over which we judge, and the long term delivery of member benefits. And so those are the two themes that sort of blend together in a way, because we're talking about having a mindset, thinking forward, thinking future, and then we have the short-term issues as well. So career risk, mindset, short, medium, long-term thoughts.
Yeah, well, I think a theme running through that is those words, or hyphenated words, long-term. The more you can be prepared to think about the long-term and accept that things will happen in the short term. But if you've got the right set of principles, values, beliefs even, then you should always be able to get through the short term and get to the long term. And pension funds particularly, I mean, they're not simple, but the simple concept. You pay some money in and you get some out. It's just a series of cash flows. And, if you make the right level of return on those cash flows, importantly, especially in our case, in the right order, which is where all the risk comes in, then you should have enough money to make sure members get the benefits in the future. And of course, it's a little bit different in DC to DB and so on. But I think being able to focus on the long term and have a really clear set of principles and a strategy which says, look, things might go wrong in the short term, and here's what we would do. So in our case, for example, we have no money coming in. So if we have to sell equities to pay benefits after they've fallen by 25%, that's a real problem for paying the future benefits. So we want to have a strategy where we can sell something else. Now, I accept Denise's point on mean reversion and those sorts of things, but it's thinking about the strategy, putting that first. And I think that the point on career risk is also tough. It's made tough by the industry and how as I've already said, and how it operates. But it's also one of leadership. And culture and management, and not just leadership of individuals in investment teams, but then support from above, whether that means a group of trustees, a CEO of an organization, or whatever it is. If the organization's aligned in delivering its mission or objectives or whatever we call it in the long term, and accepts and understands the things that may go wrong, and we won't understand all of that. And is able to manage through the short term and still focus on the long term, provide the reporting on the long term perspective rather than the short term, downplay the short term, go for the long term, etc. Then I think we'll move gradually, hopefully, in that direction. But they are certainly challenges. The industry has challenges with those sorts of things, and of course it has a set of behaviours. And we talk a lot about companies not quarterly reporting so they can focus on the long term. When do we have trustee meetings? Every 3 months, or sometimes more often. And of course, that oversight has to be there. That is a fiduciary duty. But how do we get the focus on the long term from quarterly meetings to be and that short-term noise is indeed treated that way and can be explained.
I think COVID's been quite a good example of that, where if you had a sensible investment strategy in place, you actually had to sit on your hands and say, well, this is one of those cycles, but we've got a long-term approach here. Have we got enough liquidity? Obviously, if things, we need to pay money out for benefits and so on, but that was it. And there are a lot of schemes that, their sponsors had a rocky ride, their underlying investments, their funding levels have all been all over the place, but it's been okay. They've come out the other end. There are others clearly who haven't, because they didn't have quite such a long-term view, and they've had that triennial conversation with a sponsor who has no money available to put to the pension because they do this 3-yearly bumpy ride. Long-term, it is the way to do it. And bizarrely, am I going to go on on record as saying, I think this is where the regulators got it right. Taking a long-term view is the right thing to do.
Well, maybe I'll throw something in from Christopher, who said, I can quote it. They said they got out of tobacco 20 years ago, and it's been a very, very expensive decision in relative return from what they haven't got from the tobacco sector. How long-term is long-term? I suppose part of me is tempted to say, was it an investment principle that got you out of tobacco, or was it an ethical principle? And I think that's an absolutely legitimate thing to have. And maybe in this conversation, we could tease out the difference between a values-based decision, if you like, which is absolutely fine on ethics, but actually a value-based decision, which is around valuations in portfolio, mispriced assets, and future risk that isn't priced into markets. But Denise, let's come to you in terms of this trade-off of if you have something which is based on your principles versus something which is really based on the fact, you said a great thing right at the beginning, which is that current markets are doing a very bad job of giving us the right indicators and pricing of risk and opportunity in the market. So how would you answer, Christopher, on that point, which is a great point, by the way?
It is. And I just want to say what Mark said. If I had spoken on that item, I would have said exactly what you did about culture, leadership. It starts at the top. And if you're going to go along the lines that we're discussing now, the leadership of any organization has to be prepared to take the hits, because it is just noise, as he described. I'm going to share as an example of something that that I personally invested in. And of course, at Brunel, we have to report all our transactions at year end. I don't look at my portfolio. It's somewhere, I don't have time. So I look at it at year end because I have to declare every transaction I've done in the year. And I realized last December that I still had some airlines in there, like EasyJet and Ryanair. And having the Environment Agency pension fund, we would not invest in an airport. We would not invest in such things. So thought, well, as chair of the board of Brunel, I really shouldn't own those stocks. So I sold them. And I have to say, I haven't regretted that decision. but I was lucky. I was lucky. And there are other, the tobacco example is a really good one. So where do you find the balance? And we tend to be thinking of resilience and we have our investment beliefs, and there are certain things we won't invest in that most people wouldn't invest in, arms and things like that. Tobacco is a difficult one because it has had some really good returns. But at the same time, I suppose one has to think, do I want my beneficiaries, my workers, my workforce to be smoking? Do we practice what we preach? Are we walking the talk? And I think that's where you have to really think very carefully about, yes, it does hit the returns, but it's probably the right thing to do. Because those companies are not adapting. If they will adapt, then we might see, so for example, we could have oil companies moving into renewables. I'm not saying they are, but if they change sufficiently and convincingly enough, then we don't necessarily have to have that ethical consideration. We just do what's right.
Thank you. And maybe I can move into this sort of debate about what you can achieve in public versus private markets, because in each different ways, you've either referenced the need for engagement as well as ownership. And there's an interesting question from Arun in here about private markets, scalability, and the consequences of financial repression on portfolio construction. So we won't go down the investment piece of that, because that's an entirely rich conversation for another day. But linking it back to fiduciary duty and this duty to care, how does that play into your private market investments and what you're thinking about? Anybody can start. Maybe Mark, as you're the CIO here, and then we'll see what others say.
I guess at the moment it's not a significant factor in how we choose, but again we've got some specific requirements about how we invest. We're because of our return targets, we're very illiquid, and also you've got to think, or I have to think in this case, about how you structure teams and who does what, because I think a lot of us in this industry and the peers, we split public and private up. You know, you're head of public markets or you're head of private markets, or again, we fill in asset allocation buckets. So we say we need this amount in private credit and this amount in public credit and so on. And it's difficult in that framework to sort of take an overall view, maybe to think from a risk exposures perspective or a drivers of return perspective, and to say, well, maybe technology will be a driver of return. Maybe the Asian consumer is a driver of return. How do you apply that across your portfolio, across all assets, managers, products, you know, et cetera, et cetera. So we're certainly trying to do more of that, which will include the implementation of the two schemes' responsible investment policy. Again, it's back to having the right mindset, the right diversity of thoughts, and so on in the team to sort of challenge some legacy ways of working or think about new ways of doing it. So when you think about an equity portfolio, do you say, let's carve out an allocation for, let's say, a climate change fund? Or do you say, I want to integrate the risks and opportunities that come with climate change or social issues across my portfolio? And the first one is easy. You just go and find a product or manage some money yourself. The second is a lot of what we're thinking about, but it's much more challenging to implement in practice. And I think one element of that, especially if you're using external managers, is the relationships you have with the managers. And the managers, back to my point, and Denise as well, on culture and leadership. If you've got the right attitude for the parties you're working with in the industry, then I think you've got a better chance of investing in the underlying investments. So I've not really addressed the private point, but I think it's I think it applies across all the portfolios. What I'd say on the private point is it always seems that a lot of the opportunity in this kind of area, impact more broadly, has to be done privately, and I'm not sure that's the case. Clearly, if you're investing in things like green infrastructure or social infrastructure, that tends to be illiquid and private. But I do think we need a broader view of public versus private when it comes to this area.
Thank you. Denise, do you want to add to that? Thank you, Mark.
There is a shift that has been happening over the last 10 years where the listed markets have been shrinking and the private markets have been growing. We've seen this plethora of new LPs and GPs, and in the coming months we'll see who has the resilience, because we are not yet seeing, because of all the fiscal stimulus, we haven't seen a lot of the fallout from that, and which GPs are able to weather the storm and be able to do the workouts, etc. But I think there's a huge amount of innovation going on in the private markets, and some of it is so fascinating. We've invested in a private market deal that uses treated water from sewage that's been dumping into rivers, and now is going to be used to heat up massive greenhouses that will produce 10% of the tomatoes for this country, reducing our carbon footprint, using waste. There's loads of things like that, and beyond solar and traditional sort of renewable energy. So I have a lot of hope for I'm sorry, I've forgotten what the question was.
No, it was about how you think about real assets and also the scalability. And you've actually addressed a point about scalability, because there's also a perception that it's hard to find the real asset opportunities that link to your thematic or your investment criteria, because sometimes they're small and fragmented. But I think you partly addressed that in the example you gave, actually.
I'll leave it there then.
No, that's great. Now, Lizzie, I think I just had a little reminder that we promised some time for questions. And Lizzie, do you want people to put them into the chat, or would you like people to come off mic and ask them in real life, as it were? Which would be best for you, Lizzie?
Much easier if they put questions into the Q&A function and we read them.
Lovely. So please do fill up the Q&A function. Now, there's a very, very good question here about, and Mark, you said you couldn't answer it first time round, so I'm going to give you a second chance to answer it, from Zahir Mohammed, which is around how, if let's assume you get the decision makers on board, let's just make that assumption, big assumption, but let's assume you do. What are the practical challenges? And you've referred a number of times to the culture, leadership, and process challenges in the industry more collectively. Tell us about some examples of challenges, but also some positive examples of how you overcome those. And then I'll come to Melanie and Denise on the same question after that.
Yeah, I think, well, if you've got your stakeholders on board, obviously depends on your governance structure and who makes what decisions. In our case, if we've got the strategic direction clear, then it's largely up to my team to deliver on that and implement what's going on. So that's my responsibility, and then it's about my own team culture, individuals, process, and quite frankly justification. You know, we have to make these investment decisions which could move hundreds of millions of pounds of capital around, involving often significant amounts of risk or changes in financial outcomes and so on. So we've got to be able to justify it and do it. But yeah, the practical challenges are tough. You know, we're mostly managed externally. So if we wanted to do something, access a certain risk exposure or a stream of future returns or cash flows or something, we have to have a practical way of doing that. You know, you tend to bucket things in asset classes, not always, but often. So, you know, can you do that within an asset class? If you want to do it across an asset class, how do you communicate that into your strategy? And does it sit within the existing limits that you've got and so on? And then if it's something new or innovative, are you prepared that the timescale for implementation might not just be an action you can deliver on in the next 6 weeks? That maybe you have to go out there and find somebody to work with on delivering something, and then you will find out which external managers and other providers are prepared. There's a data issue and a measures of success issue and all those sorts of things. How are we dealing with those kind of measures, and then being able to report back that we've made a difference, whether it's an impactful difference, a financial difference, or the two are, as we said before, just the same thing. But I think for me, a lot of this has been really clear on what we want to achieve. So in our case, for example, as you can probably imagine from the legacy, when we think about things like climate, it's more about a just transition. You know, the industry which my members were part of, perhaps it wasn't closed down 25 years ago for environmental reasons, but you know, it had such an impact on jobs and communities and so on, that when we think about the energy transition, then the social side of things and jobs and communities should be a part. Do we have any products out there now? I mean, we've talking about Green Gilts Plus and so on, but do we actually have any products out there which can deliver on making us the financial returns we want, but have an impact from a green and jobs and communities and so on perspective? Who's thinking about those things? So again, it's back to a bit of leadership there. You know, if that's something we want to do, could we go out and find somebody to work with in what asset classes and so on? And quite frankly, also, and here's another practical problem, at what cost?
Yeah.
Because unfortunately, some of the approaches here, I hate to say that it's just the industry saying, oh, well, there's lots of money flowing this way, so we can charge what we want. But, you know, it's often not cheap, or it's more expensive to have decisions which are more aligned with the sort of issues we're talking about here.
Do you think
Can I
that
ask
is...
Melanie to? Oh, well done, Melanie. Because I was just thinking, you've got some schemes that you call tiddlers. I mean, Mark and Denise have got at least the opportunity to dig into resources. You've got the spectrum of size. What do you think in terms of the practicalities of why not? Answering your question, why not?
Yeah, I think there's a perception that the small schemes really don't have any power to do anything, and whatever your definition of small is, it does. You know, they're using fund managers or a fiduciary manager, and they're really not getting behind the detail of the investments. But taking your example earlier of tobacco, I had a scheme with a cancer charity who clearly doesn't like tobacco. The cancer charity would not tell the trustees of the pension scheme not to invest in tobacco because they were worried about the fiduciary duty and investment return consequences. However, the trustees of the pension scheme felt it was important. they had de-risked and they had a conversation with their fiduciary manager and discovered they had 1% of their portfolio in tobacco. So they had a conversation with their fiduciary manager who was aligned, which is one of the principles we have about, you know, appointing people who are aligned with your objectives. And the manager went to that particular fund and said, would you consider reducing your tobacco exposure? And they did. And so even a relatively small scheme, you know, 50 million, had that impact, which worked well for their portfolio, even though their sponsor didn't want to run the risk of having negative returns. And I think there's a perception that, oh, I'm too small, I can't make a difference. And I think if all the small ones actually just spoke up and challenged their investment consultants, their fiduciary manager, their investment managers, and said, actually, I want this. You really have to charge me so much for it, because we now know with cost transparency how much things cost. There's got to be a direction of travel that it starts becoming cheaper, because it seems ludicrous that we should pay for something that we see as being beneficial in the long term for the planet.
No, absolutely. And I'd just like to build on that and go to Denise with another. This is an anonymous question, but it brings in the question of, you mentioned sort of fashionability at one point, and doing something because of sort of external or stakeholder pressures, social pressures, which may not bring value. And there's a sort of implied trade-off between a sort of push, which is almost NGO type push to do something which doesn't derive member value. You must get that quite a lot. How do you balance that? And how do you go back to this sense of your mission and your absolute mindset, but at the same time delivering on the member return pledge that you mentioned? How do you go about balancing that?
Well, the investment beliefs have been agreed by our underlying funds, and we reviewed those recently. And so, you know, this is what we are aiming for, and we want our strap line is forging better futures by investing for a world worth living in, and we still live by that. So that is the rock that binds us and is running straight through us. So what the way we look at it is that, you know, that's how we feel. So we feel that we are able to exercise some influence in the wider investment community. So we have expectations from our external fund managers that they buy into this. If not, we will work with someone who does. And on the other end of the spectrum, we are quite involved in on the policy, on the advocacy side, working with policymakers wherever we can to help shape that future, so that you've got a 210. This is a unique opportunity at this point in time, where we currently have a government that seems to be willing to make policy changes. But that's not without having had pressure from asset owners, and mainly asset owners. And I think pension funds have a huge amount of leverage right now to vote with their feet if we're not getting the support from policymakers, and even from our own trustee boards to do what's right. And who judges that? Well, you know, it's again coming back to the duty of care, and that collective duty of care to duty to care, or no, I think I've got it the wrong way around. Either way, it doesn't matter. You know, it is a collective responsibility, and we just have to keep reminding ourselves. And this happens a lot. We'll be at board meetings with our shareholders, and we'll say, well, you remember, we're doing this because this is one of our investment beliefs, and that's what we set out to do when we were formed, you know, 3-4 years ago.
Thank you. And can I just build on that with a question that's come in from Melanie Griffiths? Thank you, Melanie. It's a great question. It's about, do you think your roles include using your voice and weight in the companies you invest in to make them more sustainable? So in other words, it's not only about the future, it's actually that engagement in sustainable transition. Do you think you have a fiduciary duty to get involved with those companies? And that's a sort of yes, no question, I guess. So, well, how do you feel?
Yes.
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 Stewardship's a key part of this.
Yes. Although again, the diddly ones, I do find that it's harder to get the look through. The bigger you are, the easier it is to get that voice, I think. So that sounds like a cop out, but I do.
Right. So I've got
peeling
one
back the
more
layers, I think, is the difficult
No, but I think it is important, and it comes back to something I'm going to ask you in a sec. But before I do that, there's a great question from Simon Bond here. I'm having to juggle between chat and Q&A. If you could put your questions into Q&A, that's a bit helpful, because otherwise I'll miss some real nuggets here. So sorry for that. But Simon's saying, in a changing to a more transitional mindset, he's asking, who are the most intransigent? in the industry? Is it the consultants, the trustees, the members? And Simon, you're an investment manager, but I'm going to say, or is it the managers? I've got to ask that as well, Simon. So where are you finding intransigence in the industry in this shift of mindset?
Question.
It's a very good question. I think that it's almost back to this. It's almost back to why people are doing it. To answer the question, I think a lot of the why is everybody else is doing it. So now, and actually the answer to the why will be a big differentiator, I think, for the success of investors, fund managers, etc. Because the ones who are doing it for the right reasons, or at least the definition I might put on the right reasons, I think will be more successful than those who just say this is where the money's flowing, so we better have a product. So I think the mindset of, in this case, the managers so it's not the managers as a whole, but there will be very different approaches within the managers. I do think all of those parties, including ourselves as asset owners, can be very wedded to legacy ways of doing things. So there's a sort of wave of intransigence that sits there. While my panelists may have other answers, I'm going to have a think about that one and see whether I have an answer on who I think is the worst offender. And
by the way, I'm not asking you to call out by name individuals, because I don't want us to be sued, right? Although I thought Simon's question was quite provocative, but let's talk about it as an industry challenge. So Denise or Melanie?
Yeah, I mean, I think a lot of the sponsors who have been involved in the discussion around sorting out beliefs, a lot of them have had to do something from a business perspective anyway, particularly if they're listed, you know, that their shareholders are demanding this sort of information. However, I think Mark's right. Sometimes they do it because they have to, rather than actually being real beliefs. And so they've done, tick, I've done some sort of statement. And I think some managers are the same. I have trustees who say, I don't believe in any of this mumbo jumbo. So I think there's people to hang their hat on for being the naysayers all over the place. But we just have to demonstrate that there's not this doesn't come at a cost. Doing this doesn't mean we are being disadvantageous to the members or making the companies pay more to the pension scheme. You know, it is not a straight line that by taking this view, you end up making the financial position worse. That disconnect has to be created. That is not a foregone conclusion. There's too much evidence to say that is not the outcome, and that needs to be shouted out a bit more, I think.
Thank you, Denise.
I would say that for those three groups identified, that it's not so much intransigence anymore, it's more laggards. Where there may be more intransigence might be with some fund managers and some individual companies, or indeed sponsors, as Melanie has said. There's still a lot of greenwashing out there, and being able to sift through that can be tricky, particularly if you don't have a big team. In some of the smaller schemes, you know, that might be really tricky. Yeah. Just one point I'd like to make about fees. We've been seeing fees coming down across the piece for the last 3 years quite considerably. We've just had a discussion at our board is, what are we heading towards a floor on fees? Because if we want to achieve some of the outcomes and build up that data that is currently not there on all the metrics that we've been referring to, there will be a cost to that. So it may be that we will have, you know, we think we won't see a decline in fees for the next 3 years as we have seen for the previous 3 years. But in terms of intransigence, it's those two groups to me. I think the asset owners get this in the main now.
Elizabeth, can I just offer a thought on maybe how we could do things better?
Yes. That was going to be my final question to you, and that's perfect. So I can segue to you, Mark, then Melanie, then Denise, on how we do things better, because then I've got to wrap up. I've just been told we're going to run over time. So yes.
Well, I do think there's an issue with the language we all speak across those different parties, the responsible investment industry, the asset owners, the fund managers, the consultants, etc. There's a lot of commonality, and you know, I'm not talking about taxonomies and all those sorts of things, but if you go to a well-run business, you know, I spent a long time working at Unilever. If you go to a lot of well-run businesses in a lot of industries, they are doing things which are more sustainable. They are becoming more business-like about energy use and all those sorts of things. So it's not a fiduciary duty, it's just good business practice. You know, there's a danger in me and my peers. You know, we have all these things to do, and then we say, oh, we've got a responsible investment team as the managers, as there is a risk. And then there's some slightly different objectives there, and perhaps too much polarization of opinion, or perhaps in some cases emotion. You know, Extinction Rebellion in the UK may have advanced the climate change agenda, but if your main message is the world is going to end, then that's going to put a lot of people off, as well as get some on board. So maybe there's a sort of common language we need to find between all those different participants, and of course starting with what is it we're trying to achieve ultimately for our stakeholders, for our members, and as investors.
I think that's very profound. Thank you, Melanie. And we have to keep it fairly short, I'm afraid, because we've got about 2 to 3 minutes left, I'm afraid.
I think most trustee boards have had to do that. What are we trying to achieve here? So I think that the journey has started. We just need to keep it going. And I always use this quote, and I have no idea who it came from, but let's not perfection get in the way of progress. We've just got to start doing this until such time as we have got it perfect. But there's no risk, I don't think, in taking some small steps now that just become the norm. And when they become the norm, we don't get these scary statements about, I don't want to be the first one, I don't want to be the leader, I don't want to put my career on risk. That it just won't happen anymore because everyone's doing it.
Thank you. Denise.
Three A's: be agile, be adaptable, and remain authentic. And hopefully that'll get us on the right journey.
That's great language as well to those 2 points. That's brilliant. Thank you. Well, I mean, unfortunately, I'm going to have to stop. We've got some fantastic questions, and I don't want to lose them, Lizzie, because they're brilliant questions. We've got one which relates to universal ownership and how divestment isn't going to solve the problem. We've got many others around push versus pull, the role of regulation, the stick versus the carrot. I mean, this is a really rich discussion. We could have continued, but I am going to draw it to a close with first of all, before I run out of time, a big thank you to the panelists. I mean, that was a fantastic discussion. And thank you to the participants for the really rich and thought-provoking questions that have come through. Sorry we couldn't get to all of them. My last word is going to be, we do have some principles, simple, straightforward language principles for pension trustees and their advisors. If you would like them, let us know. They're available on the website, and we'll be able to get them to you if you will want to see them and you can't find them there. The one thing to leave you with is what Mark said and what others are saying, including the World Economic Forum, including big business in America. So this is mainstream thinking, which is that things are dynamic. We don't have financial and non-financial. We have a dynamic materiality test, which means that what is today considered irrelevant could tomorrow blow up a portfolio, or could be a missed opportunity that we didn't grasp at the right time. So thank you so much for a stimulating session. And I'm sure we'll get together again in a different forum because this could run and run. But thank you very much. I wish you all the very best, and goodbye. Thank you.
Thank you.